Hello and welcome back to another demo video. In this video we're going to cover problem 5-5B, which should coincide with your problem 5-5A. Okay, so in this problem, if you'll notice on the screen, I already kind of created a quasi kind of income statement, right? And they want us to compute Ashley's gross profit percentage and return on sales ratio. Super easy to calculate, right? So the first thing we need to do is recognize, well, what is gross profit? Gross profit is nothing more than sales minus cost of goods sold. So in the problem, our net sales are $300,000. Our cost of goods sold are $170,000. That means our gross profit is going to be net sales minus cost of goods sold. We end up with $130,000. So if we want to get the gross profit percentage, all we need to do is divide the gross profit by the sales, or net sales. We end up with 43.3%, okay? The next thing they want is for us to calculate the return on sales. So in order to figure that out, we got to figure out what's our net income. Well, very simple. Our net income is basically all our revenues minus all our expenses. So if you see here, we have the multi-step income statement. So I'm going to go ahead and enter in my costs, right? They tell us that the selling expense is $50,000. They tell us that our administrative expenses are $20,000. And if we take the difference, meaning we take our gross profit and subtract out our selling and our administrative expenses, we end up with operating income. I abbreviated that. It just says op income. That's operating income, okay? Here, we need to account for any other revenues and expenses. Well, we have $15,000 in other revenues, and we have $10,000 in other expenses. That gives us other revenues and expense total of $5,000. So if I add these two up, meaning my income from operations plus my other revenue and expenses, which is $5,000, I get $65,000 net income. So to figure out the return on sales, all I need to do is divide my net income, which is $65,000, divided by my net income. And I'm going to turn this into a percentage. I'm going to take it out 1. And we see that our return on sales is 21.7%. Okay? So in the problem, they tell us that Ashley is thinking about adding on a new adding on a new product, and Ashley expects that net sales are going to raise by $32,000, and the cost of goods sold that are associated just with this new product is $26,000. They tell us there's no other income or expenses that we should expect from adding on this new product. And what they want us to do is figure out what's the gross profit percentage and the return on sales ratio under this new scenario, okay? And then we have to advise Ashley on should she in fact introduce this new product, okay? So this one's actually pretty simple, and there's a number of ways to do this. But basically, at the end of the day, we need to figure out how's gross profit going to change, right? Well, we know that the sales are going to be $32,000. We know that the cost associated with this new product is $26,000. So if we subtract these two, we see that gross profit is going to increase by $6,000. Okay? So what's our new gross profit? Well, the new gross profit is $136,000. Okay, this is the new gross profit. Well, what are my sales? Well, the new sales, I'm still going to have $300,000 plus the sales from the new product gives me $32,000 or $332,000 in sales. So what's the new gross profit or the new gross profit percentage? Well, that's easy. I take the $136,000 divided by my $332,000, I end up with 41%. Okay, so my gross profit, if I add this new product, is going to drop from 43.3% to 41%. Okay? So, what's my new net income going to be? Well, I'm going to tell you right now. It's going to be $71,000. How'd you figure that out? Well, because I know that the return on sales, or I'm sorry, the gross profit is going to be $6,000 more. Okay? So let's just work with me here. Okay? So we know our gross profit right off the bat, based on this new scenario, is $136,000. Well, my selling cost did not change. Neither did my administrative expenses. Right? Those still remain the same. They didn't tell me they changed in the problem, so we have to assume that they stay the same. So that means then that my operations from income with this new product is going to be the new gross profit of $136,000 minus the selling expense of $50,000, again minus the administrative expense of $20,000. My operating income is going to go up by $6,000. Okay? They told us that don't expect any additional other revenues or expenses. So that $5,000 is still going to stay the same, right? So what's my new net income in this case? Well, my new net income is going to be my income from operations under the new scenario at $66,000 plus my other revenue and expenses, right? It hasn't changed. It's still going to remain the same. $71,000 is my new net income. So what's my return on sales under this new scenario? Well, very easy. I'm going to take my new net income, $71,000, and I'm going to divide it by my new sales, $332,000. I end up with, should be a percentage. There we go. 21.4%. Okay? So, as we can see, based on the old scenario of gross profit percentage, it decreased by, 2.3%, right? Look at our return on sales. It also dropped. It was 21.7. Now it's 21.4. So what should we advise Ashley? You should not add this new product. Why? Because your gross profit percentage has dropped. Your return on sales has dropped. Probably not a good investment. Okay? And that, my friends, is your answer for number 5. So when we come back in our next series of videos, we're going to look at chapter 6, which looks at inventory. So tune back in for that one.